Section 1.1 to 1.2 Fundamental Analysis. 1.1 What is fundamental analysis? Fundamental analysis is a method of evaluating the intrinsic value of a financial asset, such as a stock, bond, or commodity, by examining and analyzing various underlying factors that can affect its price and future prospects. These factors typically include financial statements, economic indicators, industry trends, management quality, competitive landscape, and overall market conditions. The goal of fundamental analysis is to determine whether an asset is overvalued, undervalued, or fairly valued, and to make informed investment decisions based on this assessment. The importance of fundamental analysis lies in its ability to provide investors with a deeper understanding of the true value and potential of an asset. By examining the underlying factors that drive the performance of an asset, fundamental analysis helps investors make informed decisions about buying, holding, or selling investments. It can provide insights into the financial health and stability of a company, the growth potential of an industry, and the overall state of the economy. This information can be crucial in identifying investment opportunities, managing risks, and achieving long-term investment objectives. Fundamental analysis is particularly relevant for long-term investors who are focused on the underlying value of an asset rather than short-term price fluctuations. It helps investors identify assets that are undervalued and have the potential for future growth, allowing them to make investments with a higher probability of generating returns over time. Additionally, fundamental analysis can be useful for identifying potential risks and weaknesses in an investment, helping investors avoid assets that may be overvalued or have poor growth prospects. While fundamental analysis is a powerful tool, it is important to note that it is just one of many approaches to investment analysis. Some investors also incorporate technical analysis, which examines price patterns and market trends, to complement their fundamental analysis. Ultimately, a well-rounded investment strategy often involves a combination of both fundamental and technical analysis. Along with other relevant information and considerations, fundamental analysis plays a crucial role in investment decision-making by providing investors with valuable information and insights to assess the intrinsic value and prospects of an investment. Here are some key roles of fundamental analysis in the investment process. Assessing the value. Fundamental analysis helps investors determine the true value of an asset by examining its underlying factors, such as earnings, revenue, assets, and liabilities. By comparing the intrinsic value with the market price, investors can identify whether an asset is overvalued or undervalued, which can guide their buying or selling decisions. Understanding business performance. Fundamental analysis allows investors to gain a deep understanding of a company's financial health, profitability, and growth potential. By analyzing financial statements, income statements, and balance sheets, investors can evaluate the company's revenue growth, profit margins, return on investment, and other key financial metrics. This information helps investors assess the company's ability to generate sustainable earnings and long-term value. Evaluating industry and market trends. Fundamental analysis considers industry trends and market conditions to assess the potential growth and risks associated with an investment. Investors analyze factors such as industry competition, market share, regulatory environment, and macroeconomic indicators to understand the broader context in which the investment operates. This information helps investors identify sectors and industries with strong growth potential and avoid those facing significant challenges. Assessing management quality. Fundamental analysis involves evaluating the quality and competence of a company's management team. Investors examine factors such as management experience, track record, strategic vision, and corporate governance practices. This assessment helps investors gauge the effectiveness of management in executing business strategies and allocating resources, which can significantly impact the long-term success of an investment. Identifying risks and opportunities. Fundamental analysis helps investors identify both potential risks and opportunities associated with an investment. By examining factors such as competitive landscape, technological advancements, regulatory changes, and market dynamics, investors can anticipate challenges and spot emerging trends that may impact the value of an investment. This information enables investors to make informed decisions and adjust their investment strategies accordingly. Long-term investment perspective. fundamental analysis is particularly relevant for long-term investors who focus on the underlying value and prospects of an investment rather than short-term market fluctuations. By considering fundamental factors, investors can identify assets with strong long-term growth potential and hold investments that align with their investment goals and risk tolerance. In summary, fundamental analysis provides investors with essential information to evaluate the intrinsic value, growth potential, and risks associated with an investment. By incorporating fundamental analysis into their decision-making process, investors can make informed investment choices and increase their chances of achieving their financial objectives. Fundamental analysis differs from other forms of analysis, such as technical analysis and quantitative analysis, in several key aspects. Focus. Fundamental analysis focuses on the underlying factors that drive the value and prospects of an asset. It examines the financial health of a company, industry dynamics, market conditions, and other qualitative and quantitative factors. In contrast, technical analysis primarily focuses on historical price and volume patterns to forecast future price movements, while quantitative analysis uses mathematical models and statistical techniques to analyze data and identify patterns or relationships. Time horizon. Fundamental analysis tends to have a longer time horizon compared to technical analysis, which is often used for short-term trading. Fundamental analysis assesses the intrinsic value and long-term prospects of an asset, making it more suitable for long-term investors who seek to identify undervalued assets with growth potential. Technical analysis, on the other hand, focuses on short-term price movements and is commonly used by traders looking to capitalize on market trends and patterns. Data and methods. Fundamental analysis relies on a wide range of data sources, including financial statements, economic indicators, industry reports, and qualitative information. Analysts use various methods, such as ratio analysis, financial statement analysis, and industry research, to evaluate the financial health, profitability, and growth potential of an investment. Technical analysis, in contrast, primarily uses price and volume data, along with technical indicators and chart patterns, to make predictions about future price movements. Quantitative analysis relies heavily on mathematical models and statistical techniques to analyze large data sets and identify patterns or relationships. Assumptions. Fundamental analysis assumes that the intrinsic value of an asset can be estimated by analyzing its underlying factors and that the market price will eventually reflect this value over the long term. It assumes that markets are inefficient and that prices can deviate from the fundamental value, presenting opportunities for investors to profit from mispriced assets. Technical analysis, on the other hand, assumes that historical price patterns and market trends can provide insights into future price movements, regardless of the underlying fundamentals. Quantitative analysis assumes that historical patterns and relationships in data can be used to predict future outcomes. Applicability. Fundamental analysis is widely used in evaluating stocks, bonds, and other assets in the financial markets. It is particularly relevant for value investors, long-term investors, and those seeking to assess the long-term viability and prospects of a company. Technical analysis is more commonly used in short-term trading and is applied to various financial instruments. Quantitative analysis is often used in areas such as risk management, portfolio optimization, and algorithmic trading, where large amounts of data and complex mathematical models are involved. It's important to note that these forms of analysis are not mutually exclusive, and many investors and analysts incorporate multiple approaches in their investment decision-making process to gain a comprehensive understanding of an investment opportunity. 1.2 Fundamental Analysis Framework. The fundamental analysis process involves several key steps to assess the intrinsic value and prospects of an investment. While the specific approach may vary depending on the asset being analyzed, here is a general overview of the fundamental analysis process. Define investment objectives. Begin by clarifying your investment objectives, whether it's long-term growth, income generation, capital preservation, or a combination of these goals. This will help shape your analysis and decision-making process. Gather information. Collect relevant information about the asset or company being analyzed. This includes financial statements, income statement, balance sheet, cash flow statement, annual reports, regulatory filings, industry reports, news articles, and any other sources of data or information that provide insights into the company's operations, financial health, and industry dynamics. Analyze financial statements. Review the financial statements to assess the company's financial performance and stability. Analyze key financial metrics such as revenue growth, profit margins, return on investment, debt levels, and cash flow. Compare the company's financial performance with its historical data, industry peers, and benchmarks to identify strengths and weaknesses. Evaluate management. Assess the quality and competence of the company's management team. Review the background and experience of key executives, their track record, and strategic decision-making. Consider factors such as corporate governance practices, management's communication with shareholders, and any notable achievements or controversies. Examine industry and market trends. Analyze the broader industry and market trends that can influence the company's prospects. Consider factors such as market size, growth potential, competitive landscape, regulatory environment, technological advancements, and any industry-specific risks or opportunities. Assess competitive positioning. Evaluate the company's competitive position within its industry. Analyze its market share, unique selling points, barriers to entry, customer base, and competitive advantages. Consider any factors that give the company a sustainable competitive edge or may pose challenges to its market position. Project future performance. Based on the analysis conducted, make informed projections about the company's future performance. Consider factors such as revenue growth, profit margins, market share, and industry trends to estimate future earnings and cash flows. This projection forms the basis for estimating the intrinsic value of the investment. Determine intrinsic value. Use various valuation methods, such as discounted cash flow, DCF, analysis, price to earnings, P/E, ratio, price to sales, P/S, ratio, or other appropriate methods, to estimate the intrinsic value of the investment. Compare the estimated intrinsic value with the current market price to assess whether the investment is overvalued, undervalued, or fairly valued. Make investment decisions. Based on the analysis and the comparison of intrinsic value with market price, make investment decisions. If the intrinsic value suggests the asset is undervalued and has growth potential, it may be a favorable investment opportunity. Conversely, if the asset is overvalued or its prospects are unfavorable, it may be prudent to avoid or sell the investment. Monitor and review. Continuously monitor the investment and review the analysis regularly. Keep track of any changes in the company's financial performance, industry dynamics, market conditions, or other relevant factors that may impact the investment's value or prospects. Adjust your investment strategy and decisions as necessary. It's important to note that fundamental analysis is a subjective process that involves making assumptions and judgments based on available information. Different analysts may interpret the data differently, leading to varying conclusions. Therefore, it's essential to conduct thorough research, consider multiple perspectives, and stay updated on the latest information relevant to the investment. Fundamental analysis relies on gathering information and data from various sources to analyze the intrinsic value and prospects of an investment. Here are some common sources of information and data used in fundamental analysis. Financial statements. The primary source of financial information is the company's financial statements, including the income statement, balance sheet, and cash flow statement. These statements provide a snapshot of the company's financial performance, assets, liabilities, and cash flows. Companies typically publish their financial statements in their annual reports, quarterly reports, or filings with regulatory bodies. Company filings. Publicly traded companies are required to file regular reports and disclosures with regulatory bodies, such as the Securities and Exchange Commission, SEC, in the United States. These filings, such as the 10-K, annual report, and 10-Q, quarterly report, provide detailed information about the company's operations, financial performance, risks, and management discussions. These filings are publicly accessible through the regulatory body's website, industry reports and publications, industry reports, market research studies, and publications from reputable sources can provide valuable insights into industry trends, market size, growth rates, competitive dynamics, and emerging opportunities or risks. These reports are often published by market research firms, industry associations, consulting companies, or financial institutions. News and media. Staying informed about current news and events related to the company, industry, and market is essential in fundamental analysis. News articles, press releases, industry publications, and financial news platforms can provide updates on company performance, product launches, mergers and acquisitions, regulatory changes, industry developments, and other relevant information. Analyst reports, research reports prepared by equity research analysts from brokerage firms, investment banks, and independent research firms can provide in-depth analysis and insights into specific companies or industries. These reports often include financial analysis, industry outlook, valuation assessments, and investment recommendations, company presentations and conference calls. Companies often conduct presentations or conference calls to discuss their financial results, strategic initiatives, and future prospects. These presentations and transcripts of conference calls can provide valuable information about the company's management outlook, growth plans, and response to analyst questions. Economic and macroeconomic data. Fundamental analysis takes into account macroeconomic factors and economic indicators that can impact the performance of companies and industries. Sources of economic data include government agencies, central banks, and international organizations. Economic indicators such as GDP growth, inflation rates, interest rates, employment data, and consumer confidence can provide insights into the overall economic conditions and industry trends. Company websites. Companies often provide detailed information about their business, products, financials, investor relations, and corporate governance on their official websites. This information can be useful in understanding the company's operations. Strategies and key developments. Professional databases and platforms. Professional financial databases, such as Bloomberg, FactSet, Thomson Reuters, and Morningstar, provide access to a wide range of financial data, company profiles, news, and research reports. These platforms offer advanced tools for financial analysis and data visualization. It's important to ensure that the sources used for analysis are reputable, reliable, and up-to-date. Cross-referencing information from multiple sources and verifying data accuracy is crucial to ensure the quality of the analysis. Understanding financial statements and key ratios is essential in fundamental analysis as they provide insights into a company's financial performance. Profitability, liquidity, and financial health. Here's an overview of the main financial statements and key ratios used in fundamental analysis. Financial statements. Income statement, also known as profit and loss statement. The income statement summarizes a company's revenues, expenses, and net income over a specific period. It provides information about a company's revenue sources, cost of goods sold, operating expenses, taxes, and net profit. Key components of the income statement include revenue, gross profit, operating income, net income, and earnings per share (EPS). Balance sheet. The balance sheet presents a snapshot of a company's financial position at a specific point in time. It shows a company's assets, such as cash, accounts receivable, inventory, and property, and liabilities, such as accounts payable, long-term debt, and accrued expenses, as well as shareholders' equity. The balance sheet helps assess a company's liquidity, solvency, and capital structure. Cash flow statement. The cash flow statement tracks the inflows and outflows of cash in a company over a specific period. It categorizes cash flows into three main sections: operating activities, investing activities, and financing activities. The cash flow statement provides insights into a company's cash generation, operating efficiency, capital expenditures, and financing activities. Key ratios. Profitability ratios. Profitability ratios measure a company's ability to generate profits in relation to its sales, assets, or equity. Common profitability ratios include gross profit margin, operating profit margin, net profit margin, return on assets, ROA, and return on equity, ROE. These ratios indicate the company's efficiency in generating profits and its ability to maximize returns for investors. Liquidity ratios. Liquidity ratios assess a company's ability to meet its short-term obligations and manage its current liabilities. Examples of liquidity ratios include the current ratio, quick ratio, or acid test ratio, and cash ratio. These ratios help determine whether a company has enough liquid assets to cover its short-term debts and expenses. Solvency ratios. Solvency ratios measure a company's long-term financial stability and its ability to meet its long-term obligations. Debt-to-equity ratio, debt ratio, and interest coverage ratio are common solvency ratios. They indicate the extent to which a company is relying on debt financing and its ability to cover interest payments. Efficiency ratios, such as inventory turnover ratio, accounts receivable turnover ratio, and accounts payable turnover ratio, assess a company's operational efficiency and effectiveness in managing its assets and liabilities. These ratios provide insights into how efficiently a company is managing its resources and converting them into sales and cash. Market ratios reflect the market perception of a company's value and performance. Examples include price-to-earnings ratio, P/E ratio, price-to-sales ratio, P/S ratio, and price-to-book ratio, P/B ratio. These ratios compare the market price of a company's stock with its earnings, sales, or book value per share, helping assess the company's valuation relative to its financial performance. These are just a few examples of the financial statements and key ratios used in fundamental analysis. By analyzing these statements and ratios, investors can gain insights into a company's financial performance, profitability, liquidity, solvency, and overall financial health. However, it's important to interpret these figures in the context of industry benchmarks, historical trends, and other qualitative factors to get a comprehensive understanding of a company's financial position.